Thank you very much, all of you who are joining today's webinar. We have the pleasure to have Professor Carol Alexander with us. We're delighted for that. Carol, thank you so much for accepting our invitation. This is an IFFR webinar, and it's very much in the spirit of the mission of the center, which is to bridge the gap between industry and the academia. And in fact, today's speaker has a dual career in both industry and as an academic. So Carol is currently Professor of Finance at the University of Sussex, and she is a visiting professor at Peking University Business School. She's also a fellow at IFFR, and she has also edited the Journal of Banking and Finance since 2013. Carol is an expert in fintech, in pricing and hedging financial instruments, in volatility analysis, portfolio management, and market risk analysis. Throughout her career, Carol has designed and implemented mathematical models for pricing, trading, hedging, and risk assessment for a wide range of asset management, stock exchanges, and banking clients, including Crédit Agricole, Fleming's, the New York Stock Exchange, and the Intercontinental Exchange. Carol is the author of the best-selling textbook, Market Models, and of the 4-volume textbook series, Market Risk Analysis. And very recently, she co-edited with Douglas Cumming the book on corruption and fraud in financial markets. She holds a PhD in algebraic number theory from the University of Sussex, and an MSc in Mathematical Economics and Econometrics from the London School of Economics. Before starting, let me very briefly state the ground rules. So Carol's talk is going to span 30 to 35 minutes, and then a Q&A session is going to follow. Throughout her talk, please remain muted and turn your cameras off. You may submit questions to Teams chat at any time, but all questions will be held until Carol finishes her talk. And during the Q&A session, we can take your questions in two ways. Either we will be reading the most frequent or relevant questions from Teams chat, or we can directly call on you as soon as you raise your hand. So there is a raise hand function in Teams by clicking on the raise hand icon. So Carol, the floor is yours. Thank you very much once again, and we're looking forward to your exciting talk.
Thank you very much, George. Can you hear me?
Yes, I can hear you.
Okay. I guess I'm going to share this lovely picture of a beautiful island, which I wish I were on. I'm not used to Microsoft Teams, so bear with me. I'll get my slides up. I'm afraid there is no facility to use a camera at the same time, unfortunately. So, yeah, we'll just see the slides. Thank you very much for the introduction, George. And you would have noticed that George did not say I was an expert in economics or banking, because I'm not. The thing is that George asked me to give a talk for IFFR on a topic of my choice, and instead of talking about risk management or mathematical finance or something like that, I thought it would be much more interesting and stimulating, particularly given the audience for IFFR, to talk about this. But I'm not an expert. I'm sure there's plenty of people in the audience. I've already met one just now who knows an awful lot more about this subject than I really do. All I know is what I've been reading in the newspapers, but at least I can talk, I can stimulate discussions, and this is the outline of what I'm going to talk about. I'm going to focus on the US extreme monetarist policy that's going on at the moment. Why? Well, because as we know, when the US sneezes, the rest of the world catches a cold. And it is very extreme. The simultaneous use of all three monetary policy tools, money supply, interest rates, bank reserves. This is being combined with new tools that we'll be talking about, and the widespread use of algorithmic trading by large institutions, hedge funds, and so forth, that are manipulating the prices of safe haven assets such as gold and Bitcoin, so that there's no alternative but US assets. If you want to get a return, these assets are increasing in price, bonds, equities, whatever, in a very sort of dislocated fashion to what's actually happening in the US economy. And this type of policy actually has its roots in Theodore Roosevelt's first term during the Great Depression. Currency and gold price manipulation, sustained economic stimulus have been used since then, for nearly 90 years. And all of these have been deployed to mask the true weakness of the US economy. So in this graph here, you can see the shaded regions are the years of the Great Depression. On the left, the GDP graph here shows a recession initially and then some recovery and then a faltering here. Unemployment was above 20%. And again, there was a second wave just before, but it only really came down and almost to zero when the war broke out. And look at the GDP whilst during the war years. So anyway, what was going on here? The stock market crash, 2009, precipitated very high unemployment in the US. Obviously deflation, car industry, farming, silver, everything. Were, the lobbies from agriculture and the silver mines were extreme. And so the US government aimed to increase exports via US dollar devaluation at the same time as funding infrastructure, boosting manufacturing and increasing the money supply. And how did they do that at the time? Because gold and silver were the currencies, gold for international trade, silver for domestic, the silver dollar, of course. And so in 1933, first of all, before the January 1934 Gold Reserve Act, you can see this confiscation of gold bullion occurred from May the 1st, 1933. In fact, in total, 4,300 tons of gold were taken by the US Treasury, submitted to Federal Reserve banks at a price of a little bit less than, it was $20.67. Thereafter, gold was revalued at 1 ounce of gold would be $35. So that's an immediate devaluation of the US dollar vis-a-vis gold, the currency of international trade, of 70%. Now, the profits of this confiscation, 2 billion of them, went to establish something called the Exchange Stabilisation Fund. And the purpose of that was to stabilize exchange rates, as there was the depression was exported to other countries and there was competitive devaluations trying to, every country, Europe in particular, trying to boost exports. China was more or less exempt from the Great Depression, mainly because it stuck with the silver standard. And the 1934 Silver Purchase Act, which aimed to satisfy the silver lobby, the bimetallists who wanted a fixed exchange rate gold for silver, by paying the mines an extra 50% on the market price. This was dressed up as a tax, a seigniorage tax. In return for the silver certificates became the first paper currency, and this is how they increased the money supply. Now, the role of commercial banks contributing to the 1920s stock market bubble was something that was noticed fairly soon after the crash, and these Senators Glass and Stegall, pictured here, introduced an act which prevented commercial banks getting around the banking laws, which they had done during the 1920s. They'd set up subsidiaries, now called investment trusts, to allow them to trade in stock markets, and this increased demand was one of the reasons for the stock market bubble. But the Glass-Steagall Act, I'm sure many people in the audience have heard of this, created a clear distinction between the activities of commercial and investment banks, whereby commercial banks went back to the normal business of making loans and receiving interest on those loans and taking savings from the public and companies and paying some interest on those. Another Emergency Banking Act Theodore Roosevelt enacted in his first 100 days was an extension of the 1930 Federal Reserve Act. Here you see another picture of Senator Glass and Owen here. This was the 1913 newspaper notifying the establishment of the Federal Reserve itself. In 1933, the Emergency Banking Act established this FOMC that we all know and love today. The announcements of the Federal Open Markets Committee are subject of much Wall Street speculation. So the Federal Reserve Bank presidents, well, not all of them, 5 out of the 12, plus the 7 board members of the Federal Reserve are now part of the FOMC, and their role is to control interest rates and the money supply using treasury notes, bills and bonds in open market operations. This goes back to 1933. Now, there's also a role for social media. In fact, Theodore Roosevelt's fireside chats go back to a few days after he took office. The first fireside chat, which if the technology were different, I would actually play you a recording of it because it was really interesting. It exists. It's about the role of banks, and he's explaining to the general public that banks don't just take savings. Banks invest those savings in risky assets. This is back in 1933. Anyway, the reason I've chosen this particular newspaper cutting is not just because he doesn't look very attractive in the photograph, but in response to the second downturn, which I showed you in those initial graphs in 1937, he introduced some accounting reforms in 1938, banning mark-to-market accounting, blaming that as another cause of the stock market boom, in that companies could hide their true values by, instead of using cash accounting and the accountant coming to balance the books, actually marking their assets to market with hypothetical values of company stock that weren't actually supported by sufficient liquidity. But the US did not actually recover from the Great Depression until the outbreak of World War II allowed it to take the role of the arsenal of democracy. The failing car manufacturing industry, General Motors, Chrysler, and so forth, changed to military equipment manufacturers. Unemployment fell to just a few percent by the end of the war. Industrial production increased by 15% each year during the war, and gross national product increased from $88 billion to $135 billion by the end of the war. And towards the end of the war in 1944, all of the 44 Allied countries met in Bretton Woods, USA. Here's a picture of United Kingdom sitting next to Russia, in between Russia and Uruguay, and represented by John Maynard Keynes. And Harry Dexter White, the economist, represented the US. And the agreement in the end, after a lot of argument between these two economists, was to peg their exchange rates to the US dollar within 1%. And so the balance of payments, central banks would have to either defend or either buy or sell dollars to keep their exchange rates within this 1% of the US dollar. And if necessary, go to the International Monetary Fund, which was established during this meeting, to give loans to companies. And the reason that John Maynard Keynes did not win the argument for a basket rather than a single currency was that the US had most of the gold, 4,300 tons of gold, and it agreed to adhere to the gold standard, setting 1 ounce of gold at $35. And Bretton Woods Agreement gave permanent authority to the Exchange Stabilisation Fund to more or less autonomously deal in gold, foreign exchange, other instruments of credit and securities in order to stabilize the value of the dollar vis-a-vis gold. and also to keep the profits, so that although it's established with just 2 billion, by the 2008 crisis, there was 23 billion in the Exchange Stabilisation Fund. Now, the second part of my talk, I'm going to be talking about the development of financial markets between the 1950s and 2019, obviously covering what was called the Great Financial Crisis, but this one is going to be far greater, so we'll call it the 2008 to 2009 banking crisis, shall we? I'm focusing here on Milton Friedman, most famous US economist and monetarist. And here the philosophy was free market economy. Instead of stabilizing exchange rates, which could contribute to inflation, inflation actually was going up and down and being exported from the US via the fixed exchange rates to other countries in the world. And so Milton Friedman's philosophy was to restrict the money supply to control inflation. His other philosophy later on in his Capitalist and Freedom book was greed is good. And this type of philosophy encouraged the middle classes in the US to, instead of commercial banks now, it was the middle classes that contributed to stock price booms. By 1965, 60% of company stock was owned by middle classes. And you can see this graph on the right here, the S&P 500 index going from a little over 2,000 to nearly 8,000 in the space of 15 years. But in this table below here, you can see the return on the S&P 500, and you can see dividends and the percentage of dividends as a percentage of total return, the proportion of dividends as a percentage of total return. 45% during the 1950s went to shareholders. Only 6% of profits were reinvested in the companies, and the rest went to very highly paid chief executives. And we now have a chief executive to ordinary worker ratio of around 300, which is, or at least in the US, it's much less in China, for example, only has a ratio of about 120. Okay, so I picked out these three presidents in the interim years because they all did something quite important to contribute to where we are today. So in 1971, Richard Nixon dropped the gold standard. Why did he do that? Well, because there wasn't enough gold in Fort Knox. Too many dollars had been printed. In fact, the amount of gold bullion held in Fort Knox in 1971 was only sufficient to cover 1/3 of the dollars held by foreign investors in the US, let alone domestic investors. So the gold standard was dropped, end of the Bretton Woods system. And in 1999, here's a picture of Clinton being congratulated by his cronies for repealing the Glass-Steagall Act, thus allowing commercial banks to re-enter the great casino just at the time that derivative markets were beginning, options, futures, and other over-the-counter derivatives were beginning to take off. And finally, we see George W. Bush, who reinstated mark-to-market accounting in 2007. And why do I mention mark-to-market accounting? Well, because that is the reason for the massive increase in interest rate swaps. But let's take this slide one thing at a time. In the graph on the left here, you see that the 3-month LIBOR rate was around 5 to 7% until the burst of the technology bubble at the beginning of 2001. And these shaded reasons are recessions. And Alan Greenspan, who was the longest serving president of the Federal Reserve Board, kept interest rates very low, very low. In fact, he kept them too low for too long. And during this period, 2002 and 2003, commercial banks were being deprived of their normal business. They were no longer allowed to charge high interest on loans. And so they turned to the not just capital markets, but now derivative markets in a search for yield. And so on this graph here, you can see that the total notional amount traded on financial derivatives by 2007 was 10 times world GDP. World GDP is $80 trillion. Most of it was on over-the-counter instruments, just a little on exchange-traded futures and options, relatively. A lot of it on credit derivative, foreign exchange forwards, increasing all the time, and this is continuing. But OTC swaps, interest rate swaps in particular, because banks made loans that were floating rate. Why? Because a floating rate loan, when discounted at LIBOR, is less risky than a fixed rate loan. Whereas companies who use cash accounting, they need certainty in their balance sheets. They want fixed rate loans. So banks would make floating rate loans on their loan desk, and then the swaps desk would exchange that for a fixed rate loan, hence the growth of interest rate swaps. Now, most of you will be familiar with the securitization of subprime debt that led up to the 2008 banking crisis. In the search for yield, mortgages were sold to people that could afford them on very low interest rates in 2002 and 2003. But as soon as interest rates began to rise, of course, they started to default. But this subprime debt was collateralized so that the last to default, the last loss, as you can see here, were regarded as lowest risk, had the lowest yield, and the first to default, not any particular one of those, just the first 100 to default, shall we say, was the highest yield security. So these CDOs were underwritten by investment banks and sold on to other banks, hedge funds. All large institutions were buying CDOs. And then investment banks were even, and as well as insurance like AIG, were selling credit default swaps on CDSs. Goldman Sachs sold credit default swaps on CDOs that they held. You may well be familiar with this very good film, The Big Short. On the telephone, Michael Burry ran a hedge fund which was entirely just paying premiums on CDSs. Naked CDSs. He didn't own the CDOs that he was buying the CDSs on, but he was making a bet on default of CDOs, and rating agencies were colluding with investment banks. Sorry, is the connection okay? Hello, can you hear me?
Yes, we can hear you.
Yeah, sorry.
Please, the rest of the audience, please keep your microphones off, please.
Okay. So the story in The Big Short, part of it is very interesting. S&P and Moody's colluded with investment banks to retain the good credit ratings of tranches that were then exported via London, of course, to Europe and Japan. This is the first toxic financial bomb landed on Europe and caused the 2011 European sovereign debt crisis. Nevertheless, in the US, it was still quite a crisis as well. The FDIC closed 465 banks in the next 4 years. And as well as that, there was a run on money market funds. Even if they weren't linked to Lehman Brothers, as soon as Lehman Brothers collapsed, there was a run on the funds, which was stopped by the US Treasury using this exchange stabilization fund to guarantee. This was later banned, but more recently in the Carers Act, which we'll get onto later, the exchange stabilization fund comes back again. Anyway, this just shows that on the right here, the 2017 GDP, United States was still the largest, China and Europe second largest. In 2019, US still has the largest GDP, Europe 18 trillion, China only 15 trillion. But when you look at the growth of GDP, this blue line here for China, it's clear that when Trump comes into office, it's China and not Europe, which after all has been destroyed by the financial bomb of CDOs. It's China, not Europe, that is threatening the growth of US hegemony. And what were the Federal Open Markets Committee doing before the pandemic? Well, between 2009 and 2017, there were three total rounds of quantitative easing. The first started in 2009, went on to 2010, and then two more rounds. And this begs the question whether the US economy ever really recovered from 2008, whether it's just been propped up by continual rounds of quantitative easing. Indeed, in 2017, when Janet Yellen, the only Federal Reserve president not to be given a second term by Trump in this case, so now we have Jerome Powell, but in 2017, her attempt to unwind the US national debt, well, this created money market squeezes. No longer were dollars being pumped into the system with open market operations, treasury notes and bills, and as a result, US stocks fell for liquidity reasons. And so in 2019, in September last year, there was a very surprising announcement, because not only was quantitative easing starting again, but it was the Federal Reserve buying their own T-bills. So starting in September, each program had a limit of 60 billion with overnight repos by the Federal Reserve. So the bills are issued, but then instead of looking for example, China bought a lot of QE in the first three rounds, but they're no longer interested in buying US debt. They're buying gold instead. So foreign investment for Treasury securities has more or less dwindled to nothing, and so the Fed is buying them itself. Here's the announcement details itself from the Federal Reserve Bank. And if you click on the data link here, you find a not very friendly spreadsheet, which I found particularly interesting. You have to read the dates backwards because they're not being put in properly and I couldn't change them. So this is the 60 billion limit starting in September on the right-hand side of the blue line. And then it was raised to 120 billion. And now it's unlimited, constant repo of $500 billion. Look at these operations, $500 billion in every single one. And some of them are going up to 3 months, not just overnight. As a result, instead of the contraction of the balance sheet, which Janet Yellen tried in 2017, you can see in 2018, the stock markets didn't really like that. And so it started again in September 2019, from 4 trillion, a little bit less than 4 trillion, a little bit above 4 trillion, and suddenly jumps up to over 7 trillion just since March, since the 16th of March. And the green line is the S&P 500. The NASDAQ has actually reached an all-time high, but these markets are moving in complete dislocation to what's happening in the economy. More about that soon. And the lower graph here shows the money supply as measured by M2 and the assets of commercial banks. And this blue line, the velocity of money, continues to go down, which means that the money is not going past the financial system. It's not being circulated in the economy. It's staying with large institutions, with commercial banks, with hedge funds, with those that are dealing on financial markets. The US isn't the only country that's been using quantitative easing. This left-hand graph here shows that in developed countries, the amount of debt now is as high as it was at the outbreak of World War II, 120% of GDP on average. And emerging economies are also beginning to use quantitative easing more recently, and their debt is soaring. That's the red line. And on the right, you see the pink line is the S&P 500 index, and it's crashed from the biggest crash for since before 2000, I think, since the Great Depression, actually. The S&P index fell, but immediately the dollar was defended. This exchange stabilization fund is very useful. Because it has unlimited license to operate in order to defend the value of the dollar if necessary. Not only the dollar, but also other instruments of credit and securities. So the foreign investors would not find their they'd lose on the equity return, but they'd make on the FX return at this point. More recently, the dollar has been allowed to devalue, and that is one of the things that I think is going to be happening again. We're going to start seeing competitive devaluations, just as we did after the stock market crash of 2029. Here's an opportunity now for me to give a plug to my latest book, Corruption and Fraud in Financial Markets, which George mentioned in the introduction. 21 chapters, 625 pages on malpractice, misconduct and manipulation. And I've taken a couple of graphs here just to illustrate what was happening to gold and Bitcoin as the S&P 500 plummeted. So during that dip and recovery of the S&P 500, huge COMEX gold futures were, short futures positions were put on. And it was only when the S&P 500 started to recover that gold was also allowed to recover with closing out of those futures trades. And here on the 6th of March, well, everybody expected Bitcoin and gold to soar in value, but there was a DDoS attack and various other strategies. There's a chapter specifically on manipulating cryptocurrency markets. It's very easy because there are a lot of derivatives markets which lead the price of Bitcoin and other cryptos, and these are completely unregulated. So manipulation is rife with spoofing, pinging, and any other pump and dump, whatever strategy you like. You can actually see it happening. So who are the winners? Well, hedge funds and investment banks have made very large profits. On the left picture here, you see event-driven strategies in particular, as one might imagine, have been making the monthly return in May was 3.72%. The monthly return in April was 5.91%. Still, year to date, they are down because they hadn't trained their algorithms to this massive repo that the Federal Reserve have announced. But now they can just follow the FOMC announcements and front run the markets. They're raking in the profits. On average, over all hedge funds, they are still down on the year, but making very healthy profits across the board. And the fees for investment banks for underwriting bonds, we'll get onto a new bond issuance in a minute with the term asset-backed loan facility. Deutsche Bank as well. It's not just in the US, it's in Europe as well that this type of bond issuance is occurring. Before I get on to that, let's just have a look at the losers. Well, the US household economics is not as healthy as one might think, where there's, of course, the COVID Aid Relief and Economic Security Act of 27th of March, initially pledging $2 trillion, and there have been other stimulus packages since then, in total about $3 trillion to help small businesses and consumers. The real problem is that there is about $14.3 trillion of household debt. Many different types of consumer loans have been massively securitized by not only banks now, but also, for example, student loans are collateralized into CDOs by peer-to-peer lenders like Sophie. But the jobless claims in the US, 50 million since March, are hitting these particular loans. Although the jobless rate, this graph here, the claims are falling. If you count the unemployment rate without all the revisions that have been made in the last few months, the real unemployment rate is more like 24%, which is higher than it was during the Great Depression. So now to this term asset-backed securities loan facility. Federal Reserve banks are teaming up with BlackRock, which has one of the largest asset managers, has $7 trillion under management, so it has a lot of its own reserves that it can use. So they are buying $300 billion worth of securities for consumer loans, mortgage-backed securities, not so much an issue as the car loans, credit card debt, student loans, and so forth. They're also buying new corporate debt. So this is why investment banks are raking it in with underwriting these new bond issues in exchange for credit lines up to 4 years. This is investment grade companies, so-called investment grade companies. I mean, I know General Motors may have a reasonable credit rating, but it's one of these zombie companies. It's the car industry in the US. All companies are zombie companies. They would not exist if it were not for continued bailout by the US government. Anyway, their credit line is published at $2 billion. Somebody in the Fed told me it was $3 billion or something like that, but who knows? It's a lot. They're also buying corporate debt in the secondary market, around 2.5 billion of corporate bonds from large companies, even Berkshire Hathaway Energy, McDonald's, AT&T, obviously the car companies and so forth, and smaller companies through corporate bond exchange traded funds. So basically, the Fed are buying all the capital markets. And this CARES Act has now allocated not 23 billion, but $500 billion to the Exchange Stabilisation Fund to bail out the money market funds, not just money market funds, but general bailouts, defending the dollar as necessary and so forth. Now, so what's been happening to money market funds? Well, it was the same thing following the 2008 crisis. There is a run on money market fund investments because the reason now is not default, the bank's defaults, or they will be probably, but at the moment it's not that. It's because there's zero or even negative interest rates. So investors are withdrawing from this sector, which provides $4.8 trillion of liquidity. Large money market fund managers have started to bail out private funds. Goldman Sachs have done it with their own reserves of up to, I think, 1.9 billion, but others may, Wells Fargo, for example, may draw on the ESF for these funds. Who knows? But the money market is in a really difficult position again. What's happening in Europe? Well, we have the Pandemic Emergency Purchase Programme. So a few weeks ago, the ECB offered 1.3 trillion at negative rates, up to -1%. Now, of that, about 60% is going to the commercial banks that have to repay maturing ECB loans from previous rounds of quantitative easing, but that still leaves 40% of that, around 543 billion euros, and that is for banks to buy new government bonds. We'll call these red bonds for now. So, for example, Monte dei Paschi, for example, could borrow at -1%, pay off its debt to the ECB and be left with funds where it can buy Italian government bonds at 7-8% interest. That's an immediately highly profitable carry trade. So I keep getting my bad network quality symbols here. That's why I recorded my talk. But let's hope that that I'm not going to be cut off. I'm nearly finished. Coronabonds, they're not issued yet. The countries in yellow are for, those in pink against. And why are they against? Well, these bonds would be backed by all member states. So they'd be very low interest, very high credit quality. But the view of the Netherlands, Austria and Germany is that countries like Greece would have no incentive to reduce debt if they had these bonds. And so they're likely to be limited, and the remaining debt would have to be financed using red bonds. And finally, last slide, the global economic outlook as I see it. Well, here's a picture of Donald Trump recommending that people should drink bleach in order to cure themselves of the COVID virus. And on the right, you see the number of new cases in the United States. As of the recording yesterday, I heard today that it's now 50,000 new cases. So it really is growing exponentially. The amount of spending that the Federal Reserve is going to have to, the amount of dollars it's going to have to print effectively means that this debt is going to go way above 7 trillion. And in the end, it'll be 2 or 3 times GDP. In China, it's already 3 times GDP. So I see no reason why other countries should not increase their debt to GDP ratio. There's going to be mass unemployment, particularly in tourism, hospitality, transport, shipping, all these are going to affect Greece, which already has a very high unemployment rate, in particularly young unemployment rate. So this will be deflationary. You're not going to be able to inflate that debt away. So export pressures, just as there were after the Great Depression, means we're going to have trade tariff wars. They're going to continue apace. And with this exchange stabilisation fund having 500 billion to play with now, we're going to find some very competitive currency devaluation, starting with the dollar. And effectively, this nationalisation of capital markets is continuing with the discussions of yield curve controls higher up the curve. In fact, Australia has already started to do this. We're sort of moving from an extreme form of capitalism to communism, where the Fed is governments are owning all the companies. Well, they're running the financial markets. They're no longer free. Anyway, that's all I have to say. I hope I'm still connected.
Yes.
Okay. Can I stop sharing my screen now?
It's up to you. Maybe the audience may wish, to state something on your slide, so we can keep it
okay.
for the time being. So thank you very much, Carol. Thank you for this stimulating talk. And before getting into the Q&A session, may I state that this session is being recorded. And may I also remind you that there are two ways that you can pose your questions to Carol. One is through the Teams chat room. So as soon as you write it, I'll be reading these questions to Carol. Or alternatively, you can use the raise your hand icon. And as soon as you do this, then I will be pointing to you. So I see Gikas Hardouvelis has already raised your hand. So Gikas, feel free to fire.
Sure, George. Thank you. Carol, you mentioned you had the picture of three presidents.
Yes.
And you mentioned George Bush Jr. and mark-to-market accounting.
Yeah.
So I was wondering, you didn't explain, how did mark-to-market accounting contribute to the rise of them? I guess that's what you meant, that after that, probably you had an increase in market prices, right, before the great financial crisis. So can you give us a sense, because we're not in accounting, we're in finance, so how did mark-to-market accounting contribute to the so-called bubble, or whatever you may want to call it?
Okay, well, originally in the 1920s stock market boom, Theodore Roosevelt's view was that, I've got a big echo. Hang on, perhaps if you turn your microphone off. Okay. So his view was, one of the reasons he banned it in 1938 was that companies could value themselves looking at stock prices rather than getting an accountant in to look at the books for cash accounting. And, this is one of the reasons why so many companies went bust in the Great Depression, because their value had been inflated using mark-to-market accounting. Now, banks started going back to mark-to-market accounting already in the 1960s and 70s, and it was only formally reinstated for banks only by George Bush. And so I mentioned that just to explain why in this slide here we see such a huge number of interest rate swaps. So in the notional amount of derivatives traded, at this point here, there were about 700 trillion traded notional. About 400 trillion of those were on interest rate swaps.
So if you didn't have mark-to-market accounting, you wouldn't have these swaps. I mean, the swaps you mentioned were because interest rates were low. That's what I understood. And so, and banks wanted to carry them in their books floating rate, but then the companies want fixed rates. So that's why the swaps existed.
Yes.
How did mark-to-market accounting facilitate this?
Okay.
That's what I don't understand.
Okay. Well, if I'm a bank, I use mark-to-market accounting, which means that I use LIBOR, or maybe LIBOR plus spread, to discount my future liabilities. Okay? My assets and liabilities, so that the present value of my assets and liabilities are discounted to today using floating rates in mark-to-market accounting.
Okay.
Agreed? Yeah?
Okay, yeah.
So if I make a fixed rate loan, then I'm not discounting by the same as the cash flow. But if my cash flow is linked to LIBOR, say my cash flow is linked to LIBOR plus 10 basis points, and so it's not certain in the future, but I just know that I've made a floating rate loan, so that mortgage that I've issued will change over time. But when I discount it to today, I'm using essentially the same base LIBOR to discount it. So it's not risky to a bank to make a floating rate.
So they were discounting the revenues on the asset side at essentially a risk-free rate, short rate. That's.
Well, it depends on the counterparty, but yes, it's linked to the LIBOR, to a floating rate. Whereas a company, which is using cash accounting, prefers to know for sure, even if it's a lot, as long as they know for sure, they can provision for their liabilities in future. So they prefer fixed rates. But this is not actually a central theme of the talk, really. This just explains why there's such a large market for interest rate swaps, differences in accounting.
Okay, yeah, that's what I want to understand. Okay, thanks.
Okay.
Okay, let's see. Feel free to ask questions. Okay, since the audience is a bit shy, may I ask you one question, Carol? You talked a lot about US. What is your view on UK? I mean, right now we are in a period where we have the effects of the pandemic, and at the same time we have a forthcoming Brexit. What do you think? I mean, people foresee a huge recession for UK. At the same time, what is your view about the financial health of the banking system in UK?
Well, I agree with you on the huge recession, and Boris and Dominic Cumming, their policy is spend, build, exactly the same as the Roosevelt's policy was. As I said, it wasn't until the arsenal of democracy that they built up the infrastructure, they expanded manufacturing, and basically spent their way out of the depression to build those up. And this is certainly Boris's philosophy at the moment. The one thing that as I said later, I think the battleground is going to be very unstable exchange rates again. I think there'll be competitive currency devaluations, and this will happen. I think the pound, they'll try to drive the pound down for exports as well. Banks in the UK already partially nationalised, Royal Bank of Scotland, and we have very few. There's only Lloyds, Royal Bank of Scotland, and Barclays. I think Barclays is the most unhealthy, mainly because they've been trading variance so much. And whereas credit is it's a longer term ailment, it takes longer to hit and it hits harder. Volatility is a sort of short, sharp shock. So there's no doubt to me that Barclays will have made massive losses on the volatility exchange traded funds, VXX and the TVIX, these highly leveraged products that have been rolled out retail wise. And so a lot of people will be using the volatility that came recently to redeem those. We don't know about what other banks have been doing in terms of over-the-counter variance swaps, because they are not, like credit derivatives are now reported in the BIS statistics, but variance swaps are not. It's very hard to get an idea of how much exposure our banks have to variance swaps, but I think that that's another source of losses that will be revealed in time.
Thank you, Carol. I see we have one question from Professor Perakis. Hello, Professor Perakis.
Hi. Well, Carol, let me say one thing. First of all, a gentle correction. The President of the United States during the 1930s was not Theodore Roosevelt, it was Franklin Delano Roosevelt. Theodore Roosevelt had been dead already for more than 10 years by 1930.
Oh, thank you very much.
My sense of history is too strong. I mean,
no, thank you, because I have been, as I said, I'm not an expert in economics, let alone economic history. And yes, thank you very, very much for that.
The second point, well, this is a general talk you gave about the state of the world. One thing that strikes me, you also had a tendency to link very closely the stock market and the financial markets with the real economy, as represented by GDP and the unemployment rate. Well, I know of two other people that do this, and the one is, of course, Donald Trump, who believes that if he reflates the stock market, he'll also reflate the economy. And the other is our own Yanis Varoufakis, who also believes that if the fact that we had a stock market crisis in 2008, 2009 meant we also had an economic crisis. Well, we didn't. You showed that the GDP grew after it lasted 1 year, 2008, 2009, very precisely dated. And then the GDP grew up, very, very healthy rate worldwide.
Yeah.
Right now, also, what you're saying supports the same thing. You forecast a massive recession, which I think, alas, you're right. But also, I see yesterday again, the stock market boomed. I mean, in the United States. Yeah. So there's really a disconnect here.
Yes.
Would you care say a few words? I have my own theories, but I'd rather listen to yours.
Well, as I said at the beginning, I am not an economist, not even an expert in banking. I'm just talking about this because I find it interesting, and I'm glad very much to stimulate questions and debate here. So thank you very much for those questions. Yeah, well, in terms of the value of Ford Motor Car stock, which is continuing to rise, whereas, we know that General Motors, Chrysler, and all the other automobile manufacturers in the US, they're not contributing to US GDP. Nevertheless, their stock market price is completely dislocated. Why? Because if other people are investing in those companies and the stock price continues to surge, then you get a return and you continue to do so. I agree that GDP need not be linked to stock market prices at all. They are dislocated from GDP. On the other hand, when it comes to smaller companies, and maybe I didn't emphasize this this enough, unemployment is coming from people that have student loans, that have car loans, credit card debt, and so forth. People that cannot work in the hospitality industry anymore, or transport, or so forth. That's where the unemployment is coming. It's not coming from General Motors. They're managing to keep afloat because they have such a massive credit line. Did I answer your question there or not?
Well, not very much. You agree that there is a disconnect.
Yes,
but
I agree.
Is, if you like, what moves the capital market? Okay, I have, as I said, the capital markets. What moves them if it's not the real economy? And so
it's financial institutions, hedge funds, algorithmic trading.
Okay, let me say, that's where I want to make the point. To be able to move the economy, then it means, obviously, that these markets are not competitive. A market that can be manipulated by players, by participants, then is not competitive. And I want to bring
They're not
this
efficient, yes.
They're not competitive, period. I know it for a fact for the CDS markets, which are controlled, 95% of them are controlled by exactly five institutions for the entire CDS market, okay, in the United States, big players.
Yes.
Okay, now please change your hat to editor of a major finance journal. I'm asking you, if somebody comes and tells you that we don't have free entry and competitive financial market, isn't this the if you like the Bible for finance economists? There's free entry and every model, and you have developed models, as have I, of derivatives trading.
I'm finding it difficult to. Sorry, just the last few sentences I didn't quite understand. Would you mind repeating them?
Yeah. Okay. If the markets are manipulated,
yes,
then obviously they are not competitive. Okay.
Yes. Yes.
And then a fundamental, if you like, paradigm in the study of financial markets by our profession is that they are competitive, especially in the derivatives. Everything is competitive, free entry, and no control by individual players. Is that correct? That's paradigm.
Well, that is a paradigm in equilibrium models. But if you look at the special issue that I initiated on the impact of COVID, it's not at all like that. I'm managing it in conjunction with people from the Federal Reserve in Washington. And we're really focusing on what's been happening in terms of the microstructure of these markets and the effect of the repo that's being rolled out, credit lines and so forth. So this special issue is not at all classical economics.
Yeah. Okay, I'm happy to hear this, because everything till now is, as you point out, classical economics, and there were, even during the Great Depression or the recession of 2008-9, and after the aftermath. That's all I have to say. Thank you.
Thank you very much for those comments. They were very useful.
Okay, Gigas Hardouvelis is coming back. You said something, probably, Carol, that you triggered.
No, I have a question about the future. Carol mentioned, and it's true, that European banks now, because there are negative rates in Europe, in the Eurozone, I know for a fact that the Greek banks do carry trade some money, and the ECB knows it. What's her view in 2021? Are we going to see negative rates also in the States? I mean, President Trump is pushing a lot for that. Or are we going to see the opposite, positive rates in Europe? In other words, if you were to forecast a year ahead, say at the end of the pandemic, would you see some normality coming back in rates in Europe turning positive again?
I have to say, I really find that question difficult to answer. I'm not a macroeconomist, and I can see that exchange rates are going to be key. And if there is any sort of classical economics in terms of purchasing power parity, and if those laws hold, then one would imagine that exchange rates would be in line with the direction of the currency. But at the moment, what we're seeing is that even if interest rates go negative, so money market funds, 250 billion is flowing out of the money market, then something like the Exchange Stabilisation Fund or a European equivalent will step in to provide that liquidity. So we've moved completely away from any sense of free markets or efficient markets. So I'm sorry, I can't answer whether the exchange rates, or whether interest rates are going to be negative in the US. If Trump is pushing for it and Jerome Powell doesn't seem to be as resistant as Janet Yellen, then maybe it will happen.
It's the difference between the pessimistic view and the optimistic view. If you think in the US you're going to see negative rates, then essentially we're moving in that wrong direction that you were mentioning. But if you see positive rates in Europe, maybe then rationality comes back and somehow the markets reach a more normal equilibrium, and then banks can make normal profits, as you mentioned. I thought you mentioned that the basic problem of banks was the low rates.
Yes.
And probably it is, right? So we want to see banks being healthy again. They're not healthy in Europe. They're not healthy in the US. And it's probably these very low rates that stay for a long period of time.
Yes, exactly. Like Alan Greenspan's regime. I agree. But where they're going to go, who knows? I mean, everything is so distorted now, and all markets, not only stock markets, commodities, safe havens, gold, but also bonds, completely dislocated from fundamentals.
So are we like in a situation where we need a new Keynes, a new idea, somebody who would tell us this is the way forward, this is how the global system will equilibrate?
Well, we're sort of moving back to Keynesian economics in some sense. I mean, although the velocity of money has come right down, Boris Johnson's approach is to inject money into the economy by building schools, building new hospitals, and hopefully, then we'd have the Keynesian multiplier. But I don't know enough about economics. As I said, I'm not an expert. I'm originally a mathematician. I just didn't, when George asked me to talk, I didn't want to talk about quantitative finance. I wanted to stimulate some sort of discussion on a more meaningful thing for the moment.
No, it's nice to hear you. No, it's nice to hear you.
Okay.
Okay, I think we can take a couple of questions from the chat. So one is coming from Olga Kolokolova from Manchester. So the question is the following. During the financial crisis, the notion of too big to fail appeared, and now we have systematically important institutions. In the recent years, instead of reducing their size, we see it has further increased, which is not desirable. What about the global order? It looks like we have one country which is too big to fail. Is this a problem to the global economy? Could this be addressed somehow?
This is a very big issue, and in my view, it's not just the US economy that you may call it too big to fail, but when you think about the US economy, what is it that we're reliant on in the rest of the world? It's FAMGA, it's Facebook, Amazon, Google, Microsoft, Apple. These large, massive technology companies are sort of becoming like nations. And in fact, if the US fails, then maybe they can't hide behind the US and fail to pay their due taxes, which is what Amazon and Google again in the EU have managed to avoid paying taxes on the revenues that they get here. So I think that I wouldn't say that it would be a bad thing if the US economy went under. The difficulty was from the Bretton Woods. I mean, first of all, in the Great Depression, that was exported to the rest of the world, apart from China, through the policies that Franklin Roosevelt implemented, inflation following Bretton Woods because of the fixed exchange rate. US inflation was exported to the rest of the world because of the fixed exchange rate system. But at the moment, I can't see, I mean, we are reliant on imports from the US, but not as much as we are from Europe. So I think what's more of a danger is that if the US economy starts to fail, they may get nasty about it. I mean, China is clearly going to become the new economic power, particularly this virus has just speeded it up. But I mean, there's trade wars at the moment, there's nuclear missiles all the way down the China Sea. And I wouldn't be surprised if there were some escalation of that tension if the US economy fails, and that's what we've got to look out for.
Thank you, Carol. And we have one more again in the chat from Kostas Labrinoudakis from Leeds University. Some analysts argue that the current stock market rally is partly fueled by a surge in retail stock trading via applications like Robinhood. An example of this is the rally in Hedge stock. On the same note, some analysts argue that smart money is currently selling and small retail investors are buying. Do you share this view?
That's such a difficult question. I have done a lot of macro research in order to give this talk, but this I have not. I've not really looked into. I know that pension funds are, you know, I told my friends, you know, be careful, there's going to be another banking crisis looming, you know, take your money out of risky assets, put it in national savings and investments and so forth. And yet they didn't. My retail friends are still banking on their money managers, their advisors, their financial advisors are still saying, well, if it still goes up, carry on investing. So that's as far as I can answer that question.
Thank you. I think we have a couple of minutes more. So there is one more question in the chat from Dr. Stamatiu from Eurobank. On a more technical aspect, what is your view on the effect of the ongoing transition of benchmark rates like LIBOR, EONIA, etc., on the interbank market, especially nowadays in the post-COVID era?
Well, the move by the US to I've forgotten what they were calling it. I haven't looked at this for a while, but to have a blockchain-based fix rather than the old-fashioned fix for LIBOR and IONIA is quite interesting. The problem with manipulation of LIBOR and other benchmark rates has been collusion, chat rooms. We know all about that. This is something I didn't touch on in the talk, but there is a chapter in my book all about manipulation of LIBOR. I wish I could remember what it's called, but Jerome Powell is seriously considering using blockchain so that to record real transactions, they can't be faked because they're recorded on the blockchain, and to use those as to underpin a new benchmark rate. And I think that's entirely sensible.
Thank you, Carol. Let me see if there are any other questions.
What's it called again, that blockchain-based LIBOR? Try and find out what it is.
Let me ask you one, hopefully last question. It has been a long day for you. So you are an expert in risk management, among other things. And back in 2008, we get caught by surprise. Our risk models did not work that well. For instance, the value at risk models missed completely the losses we experienced. What is your view in light of of the huge drop in the stock market in US at the beginning of the pandemic, did we learn something from the 2008 crisis in terms of improving our risk assessments? And what is your view in general about the risk management practices nowadays?
That's a very interesting question, and one at least I can answer. By the way, this is Emeribor on the 3rd of June. There's a nice article about Federal Reserve endorses Ethereum-backed alternative to LIBOR, Emeribor. Yes, now on the question of risk management, my view of the entire profession is that they are spending a large number of resources measuring minutiae, measuring risks that really are not the important risks. So this is one of the reasons why I've left risk management, in case you hadn't noticed, and turned towards fintech and microstructure and crypto alternatives, and also to corruption and fraud, because it's corruption and fraud that are the risks that those are the real risks we face. Banks lose far more in fines for fraudulent traders than they do on capital markets. So measuring VAR with this model or testing expected shortfall with that model is just keeping an entire profession employed by its own bootstraps. We aren't teaching the right thing to risk managers anymore, but the problem is that the chief risk officer does not have a seat on the board. So they don't have the power. The Basel Committee just continues to roll out rule after rule and change after change, and then everybody has to revise their risk models, but they're not really measuring the important risks at all.
Thank you very much, Carol. I guess we should have another session with you speaking about this issue. This is a very important issue since a big industry is making money out of this. So let me see if there is any other question. If not, we are going to conclude. Okay. So I think we can stop here. It was a great joy having you with us, Carol. Thank you very much for accepting the IFFR invitation and for spending time on preparing and delivering this talk. I'm sure that the audience enjoyed a lot the chance of meeting you, and we very much look forward to having you in person in Greece.
Oh, I look forward to that too, if only.
Thank you very much, all of you who attended today's webinar, and we're looking forward to having you with us in the coming webinars. Have a nice evening. Thank you so much.